All right, so for those that are connecting now, it's 2:59. We're going to give it another 1 or 2 minutes. You are in the right place. We're just warming up, getting started for this webinar that is called Startup Funding. We have 3 amazing speakers for today. I will do the formal introductions in about 1 or 2 minutes. We got about 40, 45 people connected. We're going to let a few more come in, and we're also live on Facebook. And we have quite a few people over there watching us. Maybe slowly we get started. It's 3 p.m. We can start with the introductions, and we will let the rest of the people come in. But once again, welcome to this Creative Zone webinar. As I was saying, today's topic is startup funding. We have 3 incredible speakers. I'll make some introductions. We have Stefan Hickmott, the CEO of Newfields Group and founder of Evarei. Evarei is an asset management advisory firm in the UAE with expertise spanning 25 years in the private equity, investment advisory, and management consulting, specializing in hospitality, leisure, real estate, and most recently, applications of digitalization, technologies, blockchains, among others. Stefan, welcome to this webinar. Thank you for joining us today.
Very much. Thank you. Thank you.
We have Stelios Leftheris. He's a managing partner of Vestigos. Vestigos is an advisory firm specialized in validating business concepts. They also help create state-of-the-art business plans, attract investors to startups, to entrepreneurs, find the right funding, among many other things that you do. Stelios, you're going to be telling us a little bit more throughout today's webinar. Thank you for joining, Stelios. And we have finally Chris Thomas, the co-founder and co-CEO of Eureeca. Eureeca is a pioneer in the equity crowdfunding industry, a platform that connects investors with startups and entrepreneurs under this concept of crowdfunding. Chris, you're going to tell us a little bit more about Eureeca and what you've been up to in the last few years. But once again, thank you so much, gentlemen, for connecting and being here with us today.
Thank you very much.
Maybe, Chris, we can get started with you. You have quite a bit of experience and a few years on this sort of crowdfunding, funding for startups, for entrepreneurs. How would you describe has been the evolution of funding, let's say, for startups and entrepreneurs over the years here in the UAE?
Just to thank you, Lorenzo. Just give you some context. Indeed, I mean, I've been an entrepreneur all my life. I'm 42 now. I've had one proper job as an investment banker. I got out of that as quickly as I could do, and have spent since the age of about 24 either setting up, running, or investing in businesses. And so, have throughout that journey, every business that I've been involved in has had to get some access to some external capital, be it from loans, equity, all the way through to, private equity and beyond. And so therefore are intimately involved in funding as an entrepreneur. Eureeca, which is the day job, we're also often raising money for. But as a platform, we help entrepreneurs get what we would call fit for funding, so help them with their pitch decks, their financials, their narrative, their story, and then help them campaign, or if you like, shout as loudly as possible to as many people as possible that they're looking to raise money. And assuming they're able to hit a funding target, we then take care of the heavy lifting on the other end in terms of shareholders agreements, all the KYC issuance. And actually, early next year, we're aiming to launch our secondary market. So those individuals that bought shares on the platform can now sell. So it's like an end-to-end funding solution. So indeed, I'm involved in funding and fundraising every single day, both personally and professionally. I would, in answer to your question, how has it evolved here in the UAE as opposed to the wider region or the world? It's certainly got a lot easier over the last 10 years or so. Entrepreneurship has become, a very attractive and seductive term. And if you can't be an entrepreneur, the best proxy to that is to invest in an entrepreneur. And so there has been a real push over the last 10 years in terms of both angel investors and also professionalized investors, let's say VCs, that have set up to look to involve themselves in the ecosystem. Government's doing a lot in terms of promoting entrepreneurs here. The more they can promote entrepreneurs, the better those entrepreneurs are, the more fundable they are, and therefore that's if you like, a self-fulfilling prophecy. But yeah, long story short, compared to when I first came to Dubai about 15 years ago, there is a ton more money here that is looking for a home and that is willing to invest in early and growth stage businesses. So it's a good place to be.
Excellent. And perhaps tell us a little bit more about the story behind the Eureeca. How did you come about establishing Eureeca, and how were the last few years in terms of your operations?
So as I say, I've been an entrepreneur most of my life, right? And I've always needed access to some external capital, be that credit cards, loans from my mum, all the way through to VC and PE. And whenever raising money for businesses, found the whole process very dysfunctional. I'm going back 10, 15 years ago. It was all, I knew that there were investors out there, but I couldn't find those investors. I couldn't network with those investors. I found it very difficult to raise money from VCs because there's a very closed industry and it's hard to break into. And equally, when I've had a few decent exits, which meant that I was also investing in deals. And when I would invest in deals, I found, again, that a very difficult process. You don't know whether you're getting the best deal, right? Are you getting the same valuation as someone else? Has this deal been vetted properly? Am I seeing all of the opportunities out there in the market? And we figured there must be a better way of doing this. And as with most things in this world, if you can bring it online and create a platform that effectively enables two parties, in this case, entrepreneurs and investors, to interact via the platform, you're going to make the whole process a lot more efficient, scalable, and better for all individuals. It was a business that was against the law 10 years ago. You weren't able to market and actively publicly solicit funds from investors. The credit crisis of 2008 changed that. Governments realized they need to do a lot to improve jobs. And the best way to improve jobs is to support SMEs, because 60 to 70% of the jobs worldwide are created by the SME sector. And 9 out of 10 of those jobs are created after a deal has been funded or received some capital injection. Okay, so if you as a government can figure out ways to deploy more capital to early and growth stage businesses, you're going to improve the job situation. So there was a real push towards deregulation of this space over the last 10 years or so, which we've been, we've actually been involved in lobbying various regulators, but also been a beneficiary of that, which enabled us to set up, right? Our job, like I say, is to hold the hand of the entrepreneur through the journey, but also the investor. And we provide that platform for both parties to interact. We're based here in Dubai, or we have an office here in Dubai, but we're also regulated and operate in the UK, Europe, Southeast Asia, and beyond. So it's a cross-border, cross-continent platform to link as many investors together with as many entrepreneurs as possible.
Excellent. Thank you for the introduction. And we have about 70 plus attendees at the moment. At this stage, I would like to ask you to start putting your questions on the Q&A section or here on the webinar chat part. I'll be reading from any of this section. Our attendees are mainly a lot of creative zone clients or part of our network and partners. A lot of them are startups, entrepreneurs, and I'm sure they have a lot of questions. We've done similar topics in the past, and everybody's keen to learn more about how do we go about, finding investors and funding for our projects. Stefan, a little back with you. Tell us a little bit about your background, your experience. You've been in investment banking, in management consulting. You've been many years on the other side of things, which is people coming to pitch you, to look for funding. What can you share with us?
Yeah, thanks very much, Lorenzo. Yeah, I've been living and working in Dubai since 2001. Obviously, things have changed massively in the last 20 years. And I've extensively been involved mainly in consultancy and advisory to big mega projects in the technology, real estate, hospitality space. But also in the last sort of 10, 15 years, more in the sort of private equity, funding and sort of the buy side, as we would call it, side of the equation. So I've had this in quite an illustrious career, the opportunity actually to see about 300 or 400 different groups coming pitch to me to try and sort of pitch their projects and try and win money from organisations that I worked for, where we had the money, we were the principal, we were looking to invest in good select opportunities. And I hope to share with your audience today some insights from my experiences in that. I think it's very important to be obviously extremely well organised when you go in front of an investor. It's very important to know what you want when you go into such an environment, and be very crystal clear and be very, very fair with what you want to get from the investor. If you don't know exactly what you want in terms of shareholding, how it should pan out, then leave that dialogue open. Don't try and go for something and offend the investor by asking for too much. You've got to know where all the pieces of the jigsaw sort of play before you start pushing, very confidently what you want, if you know what I mean. It depends, obviously, on the nature of your business. It's very, very conceptual stages, or if it's quite well evolved, where you're going for later seed or Series A or, further rounds of funding. Obviously, things evolve in terms of science and in terms of how you pitch. But if you have, a concept, you have an idea, then try to define it as clearly as possible. Try to go into the environment knowing the investor, really putting yourself in the shoes of the investor is so important. I would say there was one thing I could share with with the viewers today, which is the overriding negative, if you will, for anyone coming to pitch to me. It was probably that they were just being completely unfair and unrealistic of what they wanted from us. They had this sort of blinkered view of their business, how great it is, but they hadn't really considered it in terms of the investor, the risks that we would take as a financial investor, and how they might be mitigated. If they can't do that, then they're not stepping in our shoes. If they're not stepping in our shoes, if we're going into a long-term marriage, then we see risk. And that's the key thing I would say to your viewers today is think in terms of how the investor thinks. If you can be the investor when you get into the environment, when you go for a pitch, it really means a lot to the investor. It really does in terms of confidence for the investor.
So would you say that was the major gap that you saw between the relationship between people coming and pitch to find investors, that they couldn't sort of put themselves in the shoes of the other side of the investor, right?
Well, the key thing is, like I said, it becomes a kind of long-term partnership. So I'm sure that my fellow panelists will agree that some of these relationships, when you create them in terms of shareholder agreements and documentation, they're very difficult to sort of reverse out of afterwards. If you feel that you've made a mistake as an investor, it's very difficult to unwind that and get out of it, right? So they become long-term partnerships. So for me, if I got great confidence that the entrepreneurs understood the investor, understood the risk mitigation that we have to go through, understood our needs and requirements, and that comes over straight away, then that really, really helps. I'm not expecting them to be us exactly. I'm not expecting them to think exactly the same way, but it helps in terms of that synergy and that symbiosis of we're going to work well together. And I would urge everyone to really think that way. It's very important to understand your audience, as you say, before you go into the sort of equation.
Before I pass on to you, Stelios, maybe I have, Stefan, a last question for you. Gina is asking from the audience, she's saying the funding that you offer, is the criteria as stringent as that of commercial banks? This is, in fact, the real reason why SMEs struggle with access to funding, because their credit rating is poor. How do you assess this issue of the relationship between what VCs can offer versus banks versus investors in general?
Well, it's a very good question. Look, funding has so many different, faces, and if you've got you could have an idea of sitting in a restaurant tonight and chat to a friend, and they're ready to put some money in, on a verbal chat. Or you can have something that's much more crystallized and involved and needs much more serious level of funding. And typically, commercial banks, of course, are looking for low risk, and they're going to look for a loan to value of a certain equation. So there's an equity piece in there, which is the cushion for them, and they'll give a lending against that, which really mitigates their risk. Hence, with respect, the profit rate or the interest rate is relatively low compared to the equity investor who might be looking for 15-20% IRRs or more. But obviously, at the very beginning stages of the startup, you're looking to really get an angel investor, or it depends on how much you need. An angel investor or some VCs that have an appetite, specifically have an appetite for startup good ideas. And when I say ideas, it's as much about the strength of the team, if not more, than it is about the strength of the idea. Okay, so, and it's not just the team. One thing we always used to say in private equity, which is an amazing statistic, when it comes to investors into funds, for example, it's a little bit different to startups, but it's the same sort of principles. What they look for is not just the strength of the management team, but how long they've actually worked together, how long they've known each other. Because one major risk factor when it comes to investing in a business is the great CEO and the great CTO or whoever it is end up falling out with each other 6 months later, and it means disaster for the business. So the longevity of knowing the people that are in the mix at the beginning, and that they all get on well with each other and they've got a proven track record of doing so is a very important factor as well.
Excellent, excellent. Thank you for that, Stefan. Stelios, you also have years of experience in this industry. You help a lot of startups and entrepreneurs, put them in front of investors. You work through their business plans. What's your take on this? Where are we at when it comes to this relationship of startup entrepreneur and VCs and investors?
It's getting better in the sense that people are starting being a little more mature of what's needed out there. Plus, you have a lot of information available on how to raise money. There's a lot of platforms like Eureeca or Funded by Me or Angels and the Angel Network. So there's various ways to pitch an idea to people. We took a kind of a different approach. So my background is 18 years around banks. I was doing technology for banks, I was in security, and a lot of audits. So what we created in Vestigos is in essence a framework that we can do a thorough audit of someone's idea. And since most of our background is technology, we understand how this can be translated in probably a good business proposal for someone to invest to. Also, we think ourselves as a one-stop shop in the sense that if someone comes in and says, I need money for a project, ideally, I wouldn't throw them to a bank or to a crowdfunding platform or to a lending platform or to typical loans or FFF, friends, fools, and family. In essence, you advise them in different stages what they may need to go to as a source of funds and also what they can combine. And this needs to fit their own strategy. So nothing fits all and everything is customizable at that market. And you need to understand, it's very, very important what Stefan said about the how the team gels, how the team is working between themselves. And I'm far more confident working with a company which, even if everyone shouts to each other, they actually do something instead of individuals not being able to work with each other. And it has happened a number of times. We've seen, we're on average, so Vestigos is quite young, but with people which have had startups, they have failed big time, or they have failed small time. But in essence, they understand the risks of trying to sell your idea and make it survive. What has happened in the last 3 years with Vestigos is live in the neighborhood, and I'm here 10 years. We've assessed around 700 pitches that we seemed quite interesting per year. And we audited those ideas to identify the ones which made sense to work with. And in there, you understand a lot of the mentality in the region. You understand a lot about how different backgrounds of the people trying to raise money for a startup actually really affects what they're doing. So you may have the best corporate guy, but he never managed to pitch one thing. Or you may have someone who's from the street, understands nothing on financials, but he has an idea and a spirit which gets people to work with him, and it's a far better bet for me to get him in front of an investor, because he can drive the idea, he can really advertise what is on his mind and show the vision of what he has. We also try to train people in the sense that we are in the era of what's called the Twitter pitch. You have 150 characters to persuade someone. There's no elevator pitch anymore. There's no 20,000 minutes of videos or 2 minutes on TikTok. TikTok may be a good idea, but in essence, you need in the smallest amount of time to be able to show someone why you're a good thing for them. And as Stefan has seen, or Chris is assessing Eureeca, we have discussed with Eureeca before a couple of years ago, the amount of nonsense ideas that are coming in And people never do their homework, in essence, assessing whether there's someone else in the market who actually does exactly the same thing, is astounding.
Yeah.
It's not only copying someone else. You may copy something which you need to put your own flavor on and really sell that, or you copy something which is verbatim to another idea, and then you see it failing, and nobody wants to put money in you because the primary idea is still out there.
Yeah. Yeah. I believe that then, as you were saying, a bit of the challenge for the industry is to go through a lot of different concepts until you find the ones that you feel that are more serious, that the ones that have potential. There must be a lot of noise sort of around it, correct?
Correct. There is a lot of noise. That's why, again, as a one-stop shop, we have very different VCs and investor pools and areas where we can present specific type of ideas. And what do I mean by that? There's not everyone that likes light mobility. There's not everyone who likes agri-tech. There are different people that want to hear different things, which are more attracted to it. It's quite interesting around the neighborhood, and I'm talking about the whole of GCC, that the latest generation of people in the family offices are now getting away from what they had as traditional investment concepts. So everyone was doing real estate, everyone was doing maybe tourism, some this, some that, but now they're trying to pull to tech, and one of the services we have is exactly that translation. And when a family office say, okay, I'm not really confident of going in that direction, can I be helped somehow to build that knowledge around that? We can help audit the idea, and in essence even man that office with someone who understands a lot more technology and can be part of the family office. So it's not everyone for everything, and you need to approach the VCs. Usually say I'm in fintech, or they say I'm in agritech, or I'm in human technologies, or I'm in health tech. So there is some, I guess, individual approaches or from its VC or family office, but then you need to know who wants what.
Excellent.
And it's quite important. So you don't spend time presenting something which they're not interested to.
We have about 90 people connected right now, plus the people on Facebook Live. Chris, back to you. The issue of valuation, I guess, is an integral part of the whole discussion. We have a good question here from Johnny saying, for the valuation of the company that forms the basis of funding requirements, in your experience with private investors, is there a slim range of the ratio between net profit and owner's valuation, or is it completely wide and varies depending on the company and its management? What tips can we give to startups looking at this session on the issue of valuation? How do we go about valuating properly the company and bringing this to the table when it comes to sort of fundraising?
Yeah, I mean, it's a good question, and it's a good discussion point for entrepreneurs and investors alike. I mean, my advice to you, again, as an entrepreneur, as a platform also that supports a lot of entrepreneurs and investors, is really you want to kick the conversation about valuation for as late as possible, right? Ultimately, your job as an entrepreneur is to build an emotional connection with that investor, with that audience, and effectively build that relationship, build that momentum, build a fear of missing out, hot cognition, a competitive environment, and so on and so forth, such that they are eager to invest in you emotionally, right? Then you move to the analytical side of this conversation. If you start with the analytical bits, so for example, valuation, this is where we're at. These are our P&L. These are the various ratios that we are investing on, or raising money on, or assessing our success. You've lost the conversation, because once it moves to an analytical frame, you've lost that emotional element. So you need evaluation, right? You need to be able to support evaluation. There are various ways of doing that. Early, again, it depends on what stage of the business you are. If you are a super late stage business that's throwing off a lot of cash and has a lot of stability, it's relatively easy for you to determine a price point. If you're early stage, which most of us are, ultimately, your valuation is going to be driven by assumptions of growth. And I, as an investor, can challenge those assumptions, and any tweaks in that challenge of that assumption makes a significant difference to that valuation you're putting on, because there's a 5-year growth plan. I think you think you're going to do that. I think you're going to do that. Suddenly that number goes from 50 million to 3 million, right? So there's a lot of variability in terms of valuations using metrics and numbers for early stage businesses. So you're much better off looking at comparables, and that can be a bottom up comparable versus your competitors. This business in the same space as me, in either in the same market or in another market, just raised money at X valuation. We think that we are 2 years earlier or later than them in terms of their development. So therefore, we think that we're reasonably priced at Y, and or even better, this business had an exit at this valuation. So therefore, investors are willing to pay a certain price. If you can find out why those investors paid that price, for example, that they're valuing that company at $1,000 a customer, or $50,000 a supplier, and you can build actually some comparable metrics, and then you can use your numbers. We have this amount of customers, or we are meeting this revenue, etc. in our business. That enables you to approximate or defend, let's say, your valuation versus a validated valuation somewhere else, right? But valuation is an art; it's not a science. The best way for you to get the valuation you want is to ensure that you have a number of investors willing to invest in you, right? And then you've got a competitive environment. My advice, as an entrepreneur, is certainly in your early days, and by that I mean really years 1 to 5, not the first 3 or 4 months of your business, is don't be too harsh on valuation, right? Give investors a good deal. You are going to, once you start getting on this money hunt, once this train leaves the station and you're raising money, you're going to do it a number of times. And you want those initial investors in round 1 or round 2 to have a lot of goodwill towards you, so that when you're getting to that 2nd or 3rd round and valuations are now moving up and they feel that they have a paper profit or increase in the valuation, they're much more likely to reinvest and or support you, i.e. refer you to their network. And that is incredibly important. I mean, I teach quite a lot on term sheets and shareholders agreements and valuation. And again, so on that point also, as an early stage business, you can survive a low valuation. What is very difficult to survive is really harsh VC style terms. And the average VC, if you are trying to, the average investor, let's say, if you are trying to defend too high a valuation, will say, okay, you set the valuation and we'll set the terms, right? And they'll build into that shareholders agreement various rights, liquidation preference, anti-dilution, lots of really complicated stuff that really mean that you're in big trouble later on if you find that you're not able to meet that growth path. So don't be too wedded to a certain number. Look to negotiate, look to give something back to early investors, because you're going to need their goodwill as you go through this funding journey in 2nd, 3rd and 4th rounds.
Excellent. Stefan, anything that we can add on the evaluation topic? There's a few good questions coming in, and somehow it's related to this, but you can give your advice, Stefan. But it's also saying, my business is a self-funding business, but from time to time we require operational capital. Would you be able to assist on that? And how can we relate this operational capital and raising funds, down the line of the business, and this issue of valuation? Stefan?
Interesting. Okay, well, just to follow on from what Chris was saying, when you look at valuation, it's better to have, this sort of fits what he's saying, it's better to have a less complex deal. If you're a very early stage startup, have a simple agreement, maybe not the greatest deal in terms of percentages of shares and things in the world, but it's easier for you to operate as the entrepreneur. And frankly, it mitigates the risk of you losing everything. Because if you've got a deal where, you think you're going to be worth $1 billion in 10 minutes, the VC or whoever is going to hold you to that. And if you can't get there and hit that KPI, all these things are going to happen to you. It's not a great scenario for you to be in as an entrepreneur. So I think that I completely agree with what Chris says. And I think evaluations are very difficult and complex things to sort of agree upon. They can be. What I would sort of urge all the viewers to consider is this. If you think of it as a clipboard, here's a valuation, or here's what you want to achieve as the entrepreneur. and all the risks, okay? So you may be setting up a carpooling or car sharing business or ride sharing business, and you consider yourself to be like Kareem. Fine. You might be just a PowerPoint presentation at the moment. There's a lot of risks to executing to become like Kareem. So if you list out all those risks of getting to where you hit that benchmark, and you think of it like a clipboard with the tick boxes, are you actually meeting and mitigating or adhering to or, avoiding those risks? Do you have the right team? Do you have the right business strategy? Do you have a noble cause, a niche? Do you have something which actually gives real confidence to the investor that you can achieve that valuation, etc.? Because if you can go through all those things and really evidence that you can hit all those markers, as it were, then that gives great confidence to the investor. Guess what? It's all about risk and return. If the investor sees risk and he goes through the same clipboard and thinks risk, he's going to come back to you and say, you're not worth $50 million, you're worth $1 million, if that. And you're not going to get much traction in terms of with the right people, perhaps. So the best thing to do is think of it in terms of what are the risks of you achieving your business. Now, a good partner also, I would say, is not just about money. It's about them also filling in the gaps. No entrepreneur is perfect. No team is perfect. A good investor or a good team of investors will be able to fit in any issues or mitigate any issues that you have or risks that you have. If you're not very strong in certain areas, they can also help support in those areas. Now, what I'm sort of leading into here is it's not just about the money, okay? There's a lot of money out there, but, someone can just give you a check, but if they don't understand what you're trying to do, they don't understand, and have the expectations of when they're going to get their money returns, when it's very, very important that you get money from the right partners, and it's almost the partners are more important. So if a partner can help you, like Chris was saying, make the right introductions to the right people, help you evolve and go forward as a business, even put in more money later on as you hit your KPIs. That's the right sort of partner you want to be hitting, not just someone, in a restaurant that gives you $100,000 but doesn't really understand what you're doing. He's calling you 3 months later saying, where's my money back? You've got to make sure you select your partners very, very, very carefully. I would urge everyone that wants to raise money to work with the right teams of people, such as Chris and Stelios, and obviously Newfields. We advise clients on their business evolution and startup, etc. But work with the right teams of people that can really guide them in the right way, because that's so critical to a successful business, and that can evolve very quickly.
Right, excellent. Stelios, I let you also give your thoughts on the issue of valuation, but let me bring in another question. Maybe you combine the topics. There's a question that says, how much of post-funding support do you offer the selected SMEs to ensure success? At times, I find that we fund SMEs who have no financial awareness and they still fail afterwards. So if you have something on valuation, feel free. If you have some thoughts on this other topic, I like to open this new topic for the conversation.
Perfect. I'm following up what Stefan said about the risk list. When you put money in a company which is just starting out, you never are confident of what will happen in the future unless you sit with that company throughout their journey. And in essence, you don't fund them 1 million and you walk away. You fund them 100,000 every 2 months to make sure that your money gets burned the right way. So you need to be on top of what you invest on. Unless you have a huge fund and you invest to 30, 50 smaller companies, even then you have your fund managers which understand where everyone is at their journey as an SME. Again, being a technology company, we went on the valuation theme quite in a different way. We have identified in the market, and actually I know them even before starting Vestigos because I used them for my own valuations. It's not an advertisement right now, but I'm just saying the name. So we use Equidam. We do have an agreement with them, which doesn't make any difference. You can go directly and check them up, what they do. In essence, these guys bridge a gap which is very, very interesting for us. They have already 130,000 startups being evaluated as data. What that means for us is that I'm not involved. You go in there, if you really want to get your valuation, try your luck. Go in there, pay the fee, which is minimal, and try to get some numbers out of that platform. The platform would try to get you into some kind of limits, depending on your region, depending on the technology, depending on the gelling on the team, how long they've been around. So there's a number of questions that you need to answer, and then that thing whizzes about for a couple of seconds and comes out with an answer. If you're really keen to get an evaluation, this is one way of doing it. You really need to do what Chris was saying, which is in essence dig much deeper into the data of the company as it grows. Hopefully, this will happen with a company which has already been around some years. You really need to understand whether your teams had previous ventures which failed. So you understand whether they drove their previous company's valuations down because they did the wrong actions. So it always a combination of history plus numbers. You need to know the history, and then you build the numbers. For us, valuation is always a question mark game. It's always between of the past ability of the teams, and also about the value of the ideas. There's one question on the Q&A which actually says someone, how can I protect my idea? This is part of your valuation, actually. So if your idea is copied by 10,000 people and you don't really have a way to protect it, then your own value on the idea is nothing.
Good. Excellent. Thank you for that, Stelios. On this topic of sort of post-support, Chris, what is being done on this sort of the ecosystem? After we've financed, we find the investors, is there the right platform for supporting the startups to grow from there?
You mean supporting them with their business growth?
Correct, yeah.
Well, I mean, there's lots of ways I can answer that. So first point is, again, as quite a cynical entrepreneur that has raised money from lots of investors, generally investors themselves promise me lots of support and assistance in terms of building the business. But once that they have invested, their only real interest is in the return, right? And I don't blame them for that. That's not a criticism of them, but you know, you'll often get VCs that will promise you the world in terms of networks and support. And really, when it comes to, you know, push comes to shove, you don't get that, right? So yeah, there is value add in investors, and entrepreneurs are always looking for value add investors, and value add investors are incredibly precious. But in my experience, most investors, you know, for want of a better word, are a check that's signed and then they're expecting a return, and fair enough, right? So don't necessarily always just be waiting for that perfect investor. Put it a different way, if you raise enough money, you can buy in that support, those door openings and so on and so forth, by spending the money on the right staff. In terms of the post-funding support, I mean, you know, ultimately, you know, there are many business groups and intermediaries that you can use, but, you know, as an investor, I'm investing in you. As Stefan said earlier, you know, we bet on the jockey, really, not the horse. So we are betting on the entrepreneur to have the right amount of persistence and grit and focus to get over the line. You know, there's support everywhere, right? But often look to buy that in rather than expect an investor to give it to you.
Excellent. There's a question for you here from Wilhelm. Chris, it says, how much due diligence does Eureeca do on average for the startups that eventually are hosted on the platform?
We do a lot, right? So we're a highly regulated platform. In fact, we're the most regulated equity crowdfunding platform on the planet. And a lot of that regulation is related to, indeed, due diligence and treating customers fairly and ensuring that we have filtered deal flow. When an entrepreneur applies to us, it goes through a 3-phase algorithm, which is basically, you know, a filtration process that we go through. That is our DD process. That's our internal DD process. And if you like, the jaws of filtration are pretty severe. To put it into context, we get around 100 to 130 applications a month from SMEs looking to raise money, and we list about one of them, right? So, it's a pretty severe process. So DD is an incredibly important part of our journey as a platform. I mean, bear in mind also is that the very genesis, if you like, of crowdfunding is that you as an entrepreneur are using a platform like Eureeca to shout loudly to your own network, to your customers, your fans, your followers, your suppliers, people at the business school with, et cetera, and they're individuals that you want to treat very well. And therefore need to be on your best behavior with those investors, because that's your army of brand ambassadors that are going to help you grow a business. So we do a lot of DD. Our investors do a lot of DD. The benefit of platforms like Eureeca is it's effectively a social network of investors. So investors, through the wisdom of the crowds, if you like, can group together and, they can ask more questions. They can talk to each other I might be an expert in tech in Jordan, and Stefan might be an expert in food and beverage in Dubai. And there's two deals on our platform, and, we can talk about them having never have met, but, ultimately meeting on a crowdfunding platform like Eureeca and going through, the systems really to act as a social network. So we encourage a lot of dialogue, a lot of challenging of the business assumptions by investors, but there is also a very high baseline due diligence that we've done before we allow them on the platform.
Do you have some numbers to share in terms of the amount of capital that has been raised through Eureeca for startups?
Yeah, I don't have it. I don't know the exact number, but it's many tens of millions, so 30, 40 million. We have listed around 100 deals in the last 5 years. We've funded around 70% of those. We have a 70% success rate, so 7 out of 10 of the deals that come on our platform hit their funding targets. And now more and more are coming as we're getting older for follow-on funding rounds, right? Because they like the process. We help them with that post-operational support that we offer. We run nominee structures, so we'll hold the shares on behalf of the crowd, so that it's a nice clean cap table for the entrepreneur, and they can use our system to continue to communicate out to investors. So it's a bit more of it's a longer-term process, and our job as a platform really is to encourage as many follow-on funding rounds as possible.
What are the usual amounts that are being sort of fundraised? We have a good question here from Haider. He says, I saw in most platforms ideas looking for 100 and 500 to 500,000 in funding.
Well, I'll answer that question in respect of Eureeca, but also just give you just general perspectives as an entrepreneur and investor. So our sweet spot as a platform are post-operational, post-revenue businesses. We don't list ideas. We need those businesses to have been, operating, and preferably have got to revenue. If they haven't got to revenue, they need to really have some pretty amazing other boxes that they've ticked that gives us comfort they can come on. We want to de-risk these investments for our investors. So we are later stage than early, idea stuff. And the sweet spot in fundraising is raising between around $250,000 to around $2 million. Over the years, we've been moving a bit further up the food chain. So I think our average funding target now is about $800,000, but regularly have $1 million plus deals. But that's the kind of space that it fits. In answer to your point, being raising lots of money with an MVP, again, as an entrepreneur, maybe as a platform, I shouldn't say this sort of thing because I should be biased towards getting everyone to raise money. You want to, as an entrepreneur, wait as long as possible before raising money. Okay, as Stelios said, right, there are thousands of ideas out there. You need to persuade me as an investor that you're able to execute on that idea. And therefore, the best way for you to do that is to have built traction, potentially revenue, but there are other ways of building that traction, and not go to the market too early to raise money. You don't need a lot of money to get traction, right? You don't need a lot of money to get from MVP and test a few hypotheses. Don't jump onto it too quickly. Why? One, because there isn't a valuation that you're going to be able to defend. Two, it's a lot harder. But three, like I say, you're now on that money train, right? And you can't get off it. The music gets louder and louder. You made these promises to these investors. You promised them a certain growth path. You've got to spend that money in order to grow. You're now running out of money because you've spent it and you haven't hit those numbers. You've got to raise more money and more money, and it gets you very quickly as an entrepreneur can lose control over the journey of your business and also really the mission that you had. So if you can kick the can down the road as long as possible before raising money, you'll have more control, a better business, and are much more likely to raise funds.
Excellent. Stefan, there's a good question. Maybe you can help us on this one. It says, are there any regulatory requirements one needs to be aware of before embarking on the fundraising activity? We have a lot of startups and entrepreneurs here. They have questions and concerns about, when we are going out fundraising, what issues they need to be looking out for?
It's a very good question. Look, fundraising is a regulated activity. If you're going to go round, trying to canvass individual investors, sophisticated investors, whoever it might be, and pitch directly an investment into your business, it is technically a regulated activity. If you're having conversations with people about your business and that coalesces into, a coming together of minds and things, then it's a little bit more grey. And that's how most businesses come together. But, I would urge you to, without pitching Chris's platform and things, but you work with the right channels and sources for raising money. It's as simple as that, really. Don't try and do it yourself. Certainly don't market your own investment offering online, just raw yourself, without going through the right regulatory processes. It's very easy to do. Work with people like Chris, I'm pitching Chris, but work with people like Eureeca, work with people like Stelios. Take advice from myself. Happy to speak to anybody to give them any advice I can. But work through the right channels if you want to formally raise money. It's very important to do that. So that's the answer really to that. And just quickly, I want to just respond to Chris, what he was saying. He's absolutely right about delaying raising money when you start, but I would disagree, not in terms of disagreeing with what he said, but when it comes to raising the second and third rounds, absolutely pre-plan that, because the last thing you want to do, obviously, is go in front of investors when you've got nothing in the pot. And you want to say, no, we've got enough capital for a year, but we're strategically planning. And I'm sure Chris meant that as well. But I just wanted to make that clear to the viewers.
Agreed. And again, to be clear, when you're raising that first or second or third round, really the key milestone for that money is the next round of funding, right? Unless you are getting to exit or now you're getting to profitability such you don't need to raise any money. So you think of that. That's got to be your mindset. You're raising money now to get yourself big enough to raise more money at a point in the future. And therefore, like I say, the moment you get on this money train is very, very difficult to get off. And indeed, as Stefan says, you have to have a very, very clear strategy and pathway and build a lot of mitigations into that, because you're going to miss your targets. To be clear, everything's going to cost double the amount of money and it's going to take at least twice as long, right? So don't be too bullish.
Yeah, I'd say one other thing, just going back to the original question, Lorenzo. There are certain ways of raising money that you don't have to go through a regulated sphere, but it's a bit complicated. So I would urge all the viewers to just look at it carefully and work with the right sort of biases and platforms as much as possible. If you're working with sophisticated investors, then it can be easier depending on your circumstances. And if there's things called reverse solicitation where they're coming to you and you're not pitching to them, that helps. But I wouldn't say that there's any ways of getting around the regulatory environment. The regulatory environment is what it is, and I would urge people just take advice from the right people, and they will guide you hopefully and give you the right pathways.
Excellent. Stelios, what is it that we can share with the viewers in terms of what do you feel has gone right with the people that did get that funding, the people that received good investments from VCs, the unicorns of the region? That what are the key ingredients that maybe are standard across these type of companies, things that they have done correctly, so that potential viewers here can see, all right, these are the things that I need to do in order to sort of emulate what has been done by these successful entrepreneurs?
You know what they say, a leader is not a team. A leader is one person. So there's one primary person that always drives the idea, persuades the teams to stay, gets the right teams, and understands his own limitations. So at the start, you have so many different hats, but at one point you understand that you're not a financial expert. You need an accountant. You need a CTO. You need someone who knows that far better than you. So the first thing is to have the vision. The second thing is to have the ability to share the vision. It doesn't make any difference if you're an introvert or an extrovert, or you're loud and bold in US, or you never spoke to anyone before in Asia, and you're very shy. But ideally, at one point, you need to speak to someone to show the idea. And this is where it becomes interesting, because this is what they're buying. They're not buying just the team or the deck or the capability to earn money as an investor. They buy you as a leader to lead that to somewhere. So if you don't persuade as a leader, or if you don't persuade that your team supports you as a leader and provide the right capabilities, you're not going anywhere. I'm simple as that.
So we're saying that the team leader pushing the concept is a crucial part of the whole equation.
It needs someone to be in the front, leading, making sure that everyone understands what he's trying to build. And I'm talking about his team, and also the investor needs to understand what he's trying to build as an idea there in the market. Again, there are millions of ideas out there. How many of them do they actually become something? Even as a side version, everyone heard about the stories for InstaShop around here, and everybody heard the stories about Karim. It's something that may be more adapted to the region, but then eventually someone drove that idea ahead, even if it's a side copy, or even if it's based on something else. It needed someone to understand the region and the peculiarities and make that idea work here, and persuade people that he's good enough to drive that idea.
Excellent. Very good. Well, we have 8 minutes left out of this session. Maybe, Chris, to start getting your final thoughts for today, what's next for you? What's the next steps for Eureeca? Are you working on some new plans that you are able to share with us? What is it that could be some of the takeaways for the attendees for today?
Well, we as a business, from very early on in our journey, even before we launched, we realized that in order to be viable and profitable, we needed to be scalable, and to scale, we need to get across borders. And so we've been working a lot over the last few years on building the financial plumbing, if you like, as a business to allow us to get an investor from the Netherlands to invest alongside an investor in Malaysia in a deal in Dubai, let's say, right? Which is a lot harder than just marketing to those countries. There's different payment gateways, languages, currencies, onboarding requirements, legal requirements, listing, tax, all this other stuff, right? And so we spent a lot of time in getting that right, and now are aggressively trying to get our flag in the sand to as many countries as possible globally. Some of those countries, we're supporting those regulators to write crowdfunding laws. A lot of countries, there isn't a regulated framework for that, and that requires a lot of lobbying and persistence on our side. So we are working hard on that. To be honest, COVID was very good for us as a business because entrepreneurs needed cash, and we were a funding platform for them to do that. But we weren't able to grow into other markets as much as we wanted to because we physically cannot. So that's what I'm looking forward in 2021 is getting back on a plane and with my co-founder and team and starting to knock on doors in various countries. As I mentioned earlier, we're also launching our secondary market, which is a big step in the development in the industry, in the private capital markets industry. What is a secondary market? It means that investors that bought shares on our platform can now sell those shares on our platform. And that we think is going to be a great catalyst because as investors, we often have to be very patient. We have to wait 3, 5, 7, 9 years for an exit until that entrepreneur has a trade sale or some liquidity event that enables us to get a return. By allowing a secondary transaction, people to buy and sell shares, it should really open up the playing field in terms of funding. So that's what we're looking forward to 2021. Stay tuned. Look at the website. There's lots of good deals. We've just gone live with UDrive today in the UAE, which is the pay per minute ride hire car firms, currently raising, I think, 1.2 million. I think it's hit its funding target already today, just went live. So lots of good deals that fundamentally are strong businesses that had challenges because of COVID, where, this Black Swan event impacted them greatly, but are now, effectively raising money. And it's a good chance for investors to pick up some decent businesses and add them to their portfolio as we go into 2021.
Excellent. Maybe your final comments for today. What tips can you give to the attendees looking at this webinar?
Well, this is a fundraising webinar, right? And my greatest tip is that, funding is an art. It's not science, right? Or parts of it are scientific, but really it's like dating. Your job as an entrepreneur is to figure out how to push the right emotional buttons with investors, okay? And, there's lots of information out there about how to do that, but it's about, it's about telling a story. You are a storyteller. There's a narrative going on, right? And in that narrative, you need to have validation and traction, and momentum. And you really got to understand that this is not you just showing some guy your product and him saying it's great, I want to buy. There is a story behind this. The train's left the station. We're growing as a business. We'd love you to be on board, Mr. Investor, and help us breathe some magic into this. But if you're not, hey, we're already racing at 100 miles an hour. We'd love you to hop on board. It is incredibly important to understand and build that narrative into your funding journey for you to be a success. And if you get that right, I think that you'll be, greatly successful. But find social proof. Try and build FOMO and build momentum in your dialogue is my advice.
If I could just follow from that, following literally on from that, and then be completely prepared, obviously, for any questions and answers that come up. So, it'd be amazing if I could tell you how many, you'd be amazed if I could tell you how many people, hundreds and hundreds of people have come to me, pitching things to me in the past. And I'll ask for a basic thing, like, have you got a detailed business plan? And they say, oh, we need to refresh that. We need to dust it off or something like that. Doesn't give me great confidence, So be completely organized and preempt the investor's requirement and exceed their requirements. Have a virtual data room. Have everything ready. Have everything that they can possibly ask for ready, because that gives supreme confidence to the investor that these people, as I said, this long-term partnership you're going to go into is something where you can really trust, or you're getting trust from the entrepreneur that they're really going to manage your interests and your risks as the investor, that they're organized.
Excellent. So that was your tips side of things. Stefan, what's the future for Newfields and Evarei? What are you working on in the coming months?
Thank you. Yeah, well, it's going to be an interesting while, isn't it? I think we've got another 3 or 4 months, hopefully, until this pandemic starts to show a different phase of hopefully getting back to some sort of level of normality in the world. But let's see. We're interested in, we do advisory work, but we have our own portfolio of proprietary investments as well. And we're interested in digitalizing any real life business or in terms of product or service. We think there's still huge potential for the digitalization of our lives, as it were. So we're very interested in tech opportunities in that space. We think that's going to be a bigger trend this year than it has even been last year. And we're interested, obviously, in the green energy, green solution push. I think that's going to come really back into the forefront this year. Will the USA sign the Kyoto Protocol again and rejoin that initiative? I think there could be some, and obviously the post-pandemic green push, I think it's going to be enormous. There's going to be a huge amount of opportunities in that space. We think there's good opportunities for new startup businesses that can really show a compelling business case, a compelling, noble sort of cause as to what they want to do, and that they have some sort of niche or some sort of product or service which can really make an impact in this sort of post-pandemic economy, global economy that we're coming into. That's the sort of things we're looking for when we look at proprietary investments, and when we're advising clients. They're the key things I think we're going to be working on this year.
Excellent. Thank you, Stefan, for that. Stelios, your final thoughts, tips for startups and entrepreneurs, and what is that you're going to be working with Vestigos in the months to come?
So after getting a number of months trying to get the, I would say strategic partnership with Creative Zone, this took a bit of time there. In essence, we will 80% of our clients is outside the region. So we are expanding and co-branding our network to other cities, other countries. We do have some interesting tickets coming up, which most probably will be announced quite soon. Part of mobility platforms and some other concepts around that. But our main goal is to be, and I use that tagline in many of the discussions we're having, and going back to what Stefan was saying, you have a master plan, but then you have at least 6 different plan Bs, Cs, Ds, or whatever, because you need to know where you fall back when something doesn't work. And in that case, that means you need to be prepared, and you need to be bold on how you're going to be supporting your idea. One of the things we always say to our teams, and I had literally people walking out of meetings saying, I can't really answer this. Hate us before you love us. I'll do the most difficult questions, auditing you, and you need to have answers for them. If you don't, then in essence, the same questions will be asked by the investor, but there you ain't gonna get nothing, zills, no money. Be prepared to have the answers. Be prepared to get asked tough questions, and sometimes with not a very nice demeanor. So ideally, we're sitting in the middle, making sure that the idea is robust, and that someone's prepared to go and face his worst demons, which are the investors out there, or so they think they are. To do that, we are expanding expanding to various countries, so we're a bit more nearer to our other clientele out there in the market. Is also investing in a platform which is a bit of a AI-based investor to startups, social spot, like Chris was saying. But our concept of the backend is that it's far more fuzzy. It understands a lot more. It doesn't match based on Excel files or normalized ideas. It just thinks around what an investor has in his mind to what the startup is actually pitching in the platform itself. So we're expanding that direction. In a sense, what Stefan is saying, we need to digitalize everything, but also with I would guess humanized, smarter touch out there. Eventually, things will bounce back. I do expect that far bigger deals will happen in the region. The ecosystem becomes more mature, let's be honest. It's far different from what was 2 years back. There's a lot more ideas which are nurtured in a better way. And hopefully everyone, and especially the startups, gain something out of it.
Excellent. Good. Well, thank you so much, Stelios, and thank you, the three of you, for today's session. I think there's a lot of value there. We're getting a lot of questions from the audience saying, how can we get in touch with Chris, Stefan, and Stelios? I guess the answer is they all have LinkedIn accounts. Feel free to reach out to them. I don't know if you guys would like to put your email addresses on the webinar chat section there. People can write to you and get in touch with you, or you prefer people to reach out to you on your LinkedIn accounts. Either way, whatever you prefer works. But in general, I think, guys, for the attendees, you have an opportunity to reach out to these formidable people that have a lot of experience in this industry of fundraising. If you would like to be part of their platforms, of their journeys, and what it is that they're doing and how they're helping startups, please feel free to reach out. And apart from having it there on the chat, we're going to send this on a post-event email. We're going to include everybody's email because now we're going to close it down. And I'm sure many of you are not going to be able to copy this quickly. So if you're interested, take a screenshot of that quickly. and we're going to be sharing the full webinar session video to everybody's email. Chris, Stefan, Stelios, thank you so much for taking the time for being here with us today.
Thank you.
No problem. Thanks.
Thank you, everybody. Thank you to all the attendees. We'll see you again on the next one. Thank you all.
Thank you.
Bye-bye.